Just before you apply for a mortgage and during the process you've applied, what do you tell your clients, the do's and don'ts?
Well, definitely don't go out and open any new accounts, because what they're doing now is when you make a mortgage loan, we actually send out a document that says please do not open any accounts, because when you open an account it changes your debt to income ratio. But I can tell you, we close loans around here on lines of credit with banks, and we sell off that paper to a major player. They'll run a credit report after you close a loan, say 2 weeks later, before they buy it off our line. And if you've gone out and opened up any new credit, they won't buy the loan. You have to go back and re-verify everything, make sure the payments, what the payments are, what the balance is. It's a hassle. So I would tell you there's two things that people do when they're buying a house. Number one, they may go out and open another account. You could do that, but it just causes you a lot more problem, and you better figure the debt to income ratio. The other thing they do is transfer money around, and you have to always source the money. For example, let's say they got a 401k or a IRA, or they're getting money from aunt, uncle, mother, dad, brother, sister, and they put that money in their account and they think, well, I got enough money to close this. But the lenders, when they see that money coming in, they want to verify where it came from, and you have to document it. So I would say that's two of the biggest things that people do not do after they need get an application, and start moving money around without letting the loan officer know it. And number two is, do not go out and charge any stuff up. And quite frankly, I wouldn't go out and buy anything unless you just had to for at least 2 or 3 weeks after closing, because they're checking that stuff.
If I've got credit card accounts that I don't use, that I've just had the cards, should I get out there and close them before I apply? No?
No, because it's available credit. When you close your credit card account, it actually lowers your credit score. Because let's say you've got 10 credit cards with a $100,000 aggregate on them, what you could charge up. And if you cancel 8 of those credit cards and you got a $20,000 aggregate and you're using just 2 credit cards basically, the higher the balances. So never cancel a credit card, even if you don't use it, because it definitely keeps your credit score up there.
And so I'm not penalized for the available credit when I'm applying?
It's only what you're using. For example, if you got an available credit line on a credit card at $10,000 and you have a $9,000 balance on it, it lowers your credit score. If you have an available credit line for $10,000, you owe $1,500, you raise your credit score because you're not anywhere close. So the way the computer looks at it, you're living off credit cards, even though that may not be true. So it definitely has, quite frankly, if you keep your credit card balances under 30% of the available line of credit, keep your balances under 30%, your credit score is going to be up. And when they get up to 40, 50, 60, 70, 80% of what the available credit is, it lowers your credit score.